Okay, so this is our second lecture, and we'll be talking about risk. Please, I said mute yourself, and we'll be talking about risk. Now, when we talk of risk, how do you understand risk? Anyone? Or should I suggest teaching because you are going to do presentation, I'll get enough time, right? So let me go. Risk is unfavorable conditions surrounding an event. Okay. In a real world, our world, there is always risk associated with whatever we do. Right? There is risk that you can die today. There's a level of probability to lose your property. There is some level of probability that you can fall sick. So we are surrounded with risk. And when we talk of risk, we are talking of the possibility that something negative can affect expectations of what you are working towards. Deviating from what expected outcome, right? That is what we call risk. Okay, we want to understand some common elements of risk. And the first one we have is what indeterminacy. Indeterminacy. So when we say indeterminacy, we mean that you are not certain. You are not certain that it will occur. The moment you are certain that something negative will occur, there is this certainty, then there is no risk. Right? Then you can't term it as what? Risk. Another important element is loss. Now, when someone is talking about risk, or when you talk about risk, you're mostly looking at the negative aspect. There's a chance that the positive will happen. We are looking at the negative. We look at something. We meet the expected outcome, and we're not getting the return we expect from something. So risk, we not look at the negative aspect. It's likely would occur. So this element should always be in whatever you term as being risky. All right. Okay. Then we have the degree of risk. When you talk of degree of risk, we're talking of the likelihood that a negative event will happen, the probability that it will happen, right? Let's say that youth and old and a lady who is and an old, you want to look at the likelihood or the probability that one of them would die. Say that the old woman's one is what? Higher. The probability that he would die is higher than the right? So that is of this. Some risk can be, some cannot be. Especially the insurance, they measure better, able to measure to come out with, right? Determine the right going to pay. So that is it. Now, when that time you compete with risk, we have peril, we have hazard. I believe that if you want to check the standards of risk, this peril is right. Now there is a slight change. There is slight difference, right? When we talk of a peril, we are talking about a cause of loss, a cause of a loss. What could cause? Okay. All right. So example is fire. Your house, say, the house can be bent, right? And it could be caused by what? Fire. So the peril here is what? Fire. Right? That they stole someone's phone. The peril here is what? Theft. Then we have hazard. Hazard. When we talk of hazard, we are talking of, can you see? Can you see? Okay. So when you talk of hazard, you're talking of a condition that is the chance of a peril. So there is something can increase the chance of fire occurring in property. Okay, so that's what we call what hazard. What we call what hazard, right? So hazard, we have various types of hazard. We have one of them is we have physical hazard. Physical hazard. So now let's look at some of the hazard for fire. We can talk of how the wiring of the house was made, right? If it was done professionally, it was done for that physical happen for there to be outbreak of fire, a stove, right? But if the wiring was done bad, then very likely event that the kind of the character of the people living in that would also be what hazard, right? So if uh, physical hazard, so if the people there are very careful, they don't obey the same associated with electricity, then they are likely to cause the place to burn or create fire, electrical fire that can cause, or even gas can also cause that. So that will be the physical hazard. We have moral hazard. Where's my cousin? Yeah, moral hazard. And when we talk of moral hazard, we are talking of this harmless behavior from person, which causes what a peril, which causes create or increase the chance of what. So a practical example is probably someone has built a car and he thinks the car is old, wants a new one, and therefore can do something to increase the chance of the car being damaged, right? The person can do the car being. Yeah, can you hear me?
The line is breaking.
Can you
The
hear
line
me
is breaking.
now?
Yeah, I can hear you.
Okay.
I don't
So
know. Yes.
if out of this harness behavior of
hello, Doc. For hearing, we are hearing you, but the problem is that it is breaking or echoing. So we hardly get the clearer, the clarity of the speech that is coming.
okay. Please, can you hear me now? Is
Yeah.
the line breaking?
Now it's better.
Now it's better.
It's okay, yeah, Doc. Yeah.
Yeah, so moral is dishonest behavior from someone cause a loss. Okay. And I was giving a practical example that if someone has maybe insured his car, maybe comprehensive, and he knows that if something happens to the car, they will damage by him or her, the person can do something to get the car damaged, either going to be stolen, either for fire outbreak, so that the insurance company can what replace it for him or her. So that will be a practical example of what moral hazard. Then we have moral hazard. When we talk of moral hazard, this one we are talking of you being careless in your actions, being careless in your actions, to the extent that it increases the chance of what a peril, causing a loss. Okay, so this one is you being careless. You don't really intend for something to happen, for you to lose something, or for a fire outbreak to happen, or for your phone to be stolen. However, you are very careless. You are walking on the street of Kumasi. Let me use Kumasi because, and at a place that is known for stealing, then you are holding your phone out in the window, they are likely to take it from you. So it's you being what? Careless, right? Because if you are being careful, you make sure that your phone is in your what? Pocket, right? You having money in your bag and you open it for everyone to see, and then you are likely to be robbed. Okay, so that is you being careless. Then we have that hazard. There are some things that increase peril, right? That is legally bad. That is legally what? Bad. Okay. So let's say that let's get an example like maybe they have a particular way that they want to do a building in a particular estate, and it's legally backed, it's legally accepted, and you already have your building there in a different style. They can ask you to demolish it, and you demolishing that property is a loss to you. So we have some losses that is what legally backed. Okay, all right. We have various classification of risk. We have various classification of risk. We have static and dynamic risk. Static and dynamic risk. Let me start with dynamic risk. When we talk of dynamic risk, we are talking of changes in an economy that causes loss to a person. Changes in, please, I said mute yourself. Mute yourself. Okay. Changes in an economy that affect what? That causes loss. So a typical example is COVID. COVID caused a lot of loss, and many people were affected, right? So COVID, inflation. When inflation goes high, many people are what? Affected. Cost of borrowing increase, right? Because inflation is a form part of what? Interest rate. Okay, the quoted one, one part of it. Okay, so there are some changes in the economy. It can affect your income, right? Technological change. You know, sometimes enhancing technology can cause a work loss, right? But now they don't need you. They don't need you. What they needed 10 people to do, now they need one person to operate the machine to what? Do it. And they can't keep you there. It's a loss to them. So they will have to lay you off. And by laying off, you have lost your what? Your income, your monthly income. Okay. So that is what dynamic risk. Then we have static risk. When we talk of static risk, we are talking of a risk that occur even though there is no change. Whether there is change in the economy or not, it will affect you. So maybe your car was stolen, right? Whether they will change in the economy, it didn't happen as a result of change in the economy or changes that occurred in the economy. Okay, so that is static risk. Then we have another classification, fundamental and right, fundamental and particular risk. Okay, fundamental risk is a risk that affects what? Group. So it can be related to dynamic. When dynamic risk affects all those in an economy. So if a risk affects a group, then fine. So let's say in a firm, maybe the firm goes bankrupt. When the firm goes bankrupt, it affects the group, all those that are working in what? In the firm. So this is an example of what? Fundamental what? Risk. Then we have risk. This risk affects an individual. It affects what? An individual. Now, let me give another example of fundamental risk. I will use flood, right? That occurs in a particular area. People lose their property. People lose their burden. Then we are talking of fundamental risk here. Now, when you talk of particular risk, it affects an individual. So that was I'm going to use the example of being laid off from Probably your car being stolen, your property catching fire. It's a particular, it's affecting only you, right? So it's not fundamental. It's not fundamental to a group. It's not affecting a group. That is what particular is. Then we have pure and speculative risk. And I will start from speculative risk, right? When you talk of speculative risk, we are talking of risk which give you the chance to gain or lose. Which give you the chance to what? Gain or lose. And most of the time, this type of risk, we put ourselves in that position. A typical example is what? Gambling. It's what? Gambling. If you go and gamble, who got your bet? Who got your better? Boom. Get your bet. Huh? Who got your better? Eh? When you bet, you either lose or you gain, right? So speculative rate is a rate that gives you the chance to what? Lose or gain, right? Then we have pure rate. Pure rate is associated with losing only. So you have your property. I already have my property, I have my burden, I have my car, I have my work, and there is a possibility that I can lose that work. There is a possibility that I can lose that car. There's a possibility that I can lose that burden. So for pure risk, it only deals with what? Loss. Okay. So that, and most risk we encounter in our life is pure risk. Right. Okay. Then we have classification of pure risk. Classification of pure risk. We have personal risk. Personal risk. We are talking of risk that affect you as an individual. It affects your income, the ability to earn income, or your assets, an asset you own, right? Your ability to earn income or an asset you own. So imagine if someone gets an accident and the person becomes disabled, the person can lose his or a job and can lose his what? Income. Okay. All right. So someone else the house, personal risk. We have property risk. We have property risk. So that is you losing a property. Simply you losing a property. Then we have liability risk. Liability risk. This risk that happens when you become liable to someone. Okay, you somehow become obligated to do something for someone, which will result in you losing something. Okay, so in our law, if you destroy the property of another person, probably carelessly, like negligently or mistakenly, you just you are driving and you hit someone, and there's an accident, you are the cause, then you are going to what? Have to bear the cost of the person's hospital bill. And this will cause you what? You to lose what? Income. Will cause you to lose what? Money. Okay. All right. So that is liability risk, right? Then we have risk arising from failure of others. Okay. So you contract someone to do something for you, the person doesn't do it, either doesn't do it at all, doesn't do it on time, or does it wrongly. If there are instances where you ask someone to do something for you, the person will do it wrongly, and you have to bear additional cost of contracting another person to do it correctly for you. Okay? There are instances where you need something today to get something. Then it happens that at the time you give for the contractor to execute or to do whatever you require from him or her for you, the person wasn't able to do it on time. And as a result of that, you lose something. So that is what we are talking about. Risk associated from failure of others. Okay. Now, since we say risk is you cannot escape risk, it's inescapable. That risk in the real world, we are always associated with risk. Your going and coming is risky, right? There's no guarantee that when you go out today, you come. No matter how safe your road is, there is some 0.00001% that you might not come back. Okay, so therefore we have to do what? Manage our risk, right? We have to manage our risk. Okay, and there are various ways of managing our risk. When it comes to investment, we talk about portfolio diversification, right? And as a finance person, we know diversifying your investment reduce what? Your risk of you reduce what? Losing your return or even losing your principal investments. Okay. All right. Then we have hedging. Hedging is where you take a point, a strategic point, right, to lock your loss. Eh? To lock your loss. Then we have insurance, right? Insurance is you what? Transferring your risk to another person so that in case it happens, you'll be what? Indemnified. So we'll be discussing these three ways of what? And dealing with what? Risk. Okay. Very briefly, then come in and do your presentation. So I cannot talk of portfolio management without talking of investment, right? When we talk of investment, it's you committing your money into something, maybe into an asset, expecting what? Returns in future, okay? Expecting returns, okay? And when we go to investment, what we use to measure risk is standard deviation or variance, okay? All right, so that is it. Then when we talk of risk on investment, we are talking of the likelihood that you will not get your return back, or you might not even get your principal investment back. Okay, so that is this. And we have two broad categories of risk and investment. And we have systematic and unsystematic. We term systematic risk as risk that cannot be diversified. It cannot be diversified because it is market conditions that affect everything. If inflation is high, it's affecting everything. It's affecting food, it's affecting everyone, everyone, everyone. I'm not long ago, I was listening to someone. I said, nowadays when you go to the shopping mall, you don't see the crowd there. Why? Things are very expensive and people don't have money to spend. People don't have money to spend. They don't have spare money to go and shop or just go for excursion there or just go and have fun. No, people don't have. Monies are tight now. Every money you have has something to do. Okay, so that is it. Then we have what? Unsystematic risk, right? This particular risk can be diversified. It can be diversified. I mean that if you are able to invest in more than one asset, and then you can reduce the tendency of you losing your investment or your returns. Okay, so that's based on investment. Now return is what we require to get on our investment, right? What we are expecting to get on our investment. Okay, all right. So there are some assumptions associated with calculation of risks in finance. And one of them is that I always say that in finance, because to come out a formula, right, you need to assume, because economists, when they are talking, we always say that all other can be held constant. But if you don't assume, then there will be a lot of factors in the formula. And if you mean the formulas would have been more complicated. Some might not even be able to go on a paper for you to be able to learn, right? So in finance, we normally assume it comes with assumption for us to be able to come out with a proper formula, right? For us to be able to solve a question. Okay, So we assume that investors are risk averse because most of us we are risk averse. Me, I'm number one. I'm risk averse, right? I remember a student asking me, so why is that I don't own shares? The country I live in itself is risk, and the income I earn is too small for me to spend. Than for me adventure, right? So investors are what? Risk averse. Then investment return follow a normal distribution. So these are some of the assumptions when I'm under what? Investment. Then we have basis for selecting investment, right? So basis for selecting investment assets. Number one is utility score. Utility score. When we talk of utility score, we are talking of the satisfaction you are getting from what that is. So if you have satisfaction in the investment, then you go in for it. Another one is what? Mean variance criterion. Now, when you talk of mean, I said that to measure returns in finance, we use mean, right? And to measure risk in finance, we use what? Variance. In other words, the person is comparing its return with the risk to know whether he or she needs to what? Invest or what? Or not. Then we have minimum risk portfolio, meaning that when people are going in for investment, they consider what? The one with less risk, with the least risk, right? That is what they go into. And I'm a typical example. Now, want to discuss single investment versus portfolio, right? Single investment versus portfolio. We introduce portfolio here as one way of what? Minimizing risk. As one way of what? Minimizing risk. And that it encourages what? Diversification. So single investment is investing in what? In a single asset or in one asset. In one asset. What they are saying now is if something happens to this asset or this investment, it means you will lose everything. You will lose what? Everything. Right? So look at it let me don't put your eggs in one what? Basket. But if that basket falls down, lose all the eggs. But if you could divide them into different containers, when one for the rest will be there, right? So that is it. So portfolio is spreading your investment. That is investing in more than one asset, right? Investing in what? More than one what? Asset. Okay. So if I invest, I want to do investment, I have some money, I want to do investment, and I want to diversify, minimize the risk by risk of losing my returns, the principal amount I'm investing. What I will do is that I will invest more than one asset. I won't go and invest my money in one asset. So I'm as an investment in Ghana. And can you help me out? Investment in Ghana. So maybe I go and buy even now, as we stand now, the trading bill, for me to even go and invest all my money in trading Ghana trading bill now, I'm afraid. Because of what happened to those who had the treasury bond. And the way the economy is going, don't trust anything. You don't trust the people. And what happened to cocoa? The cocoa, how they call it? Cocoa, they had some trouble with themselves. What happened to them? So even now, I will not be surprised if government get up tomorrow and say we don't have money, so we are not paying you back. Or we are not going to pay this time, we are going to pay next year. Okay. So as it stand now, I will not go and as it were, as we see treasury bill to be free, that I could just put all my money there, invest all my capital there. I'm not going to do it again because certain factors happening in the country is making it risky for me now. Okay, so that is it. We have what? Data used for calculating risk. Sometimes we use historical data. One of them is historical data. Historical data, because that what has happened before is likely to repeat. Okay, it's very likely to repeat. So if a firm has not been doing well over the years, and just as I said, the second, you don't, based on historical data, I wouldn't invest in that. This firm has not been performing well for 5 years, and the 6th year, somehow a magic happened, and they are performing well. Then I'll look at all the data and go and invest my money there. No. So we use historical data to calculate. Then we use probability data to also calculate risk. Now I want to know factors that determine portfolio risk. Factors that determine portfolio risk. To now diversify, there are some things that affect portfolio. You don't just, you don't just get up and say, oh, portfolio, investing in more than one asset, let's go around just investing. You have to understand this thing, that the individual risks, individual investments come together to affect what? Your risk, to determine your risk. Okay. The risk individual investment. So if asset A has 70% risk, asset B had this risk, then you diversify. This individual, their risk is what is coming together to form what? Your risk. Hence, you have to also look at the proportion of what? Your investment, the proportion of the investment. So what portion do you take care? What portion do you take care? What proportion do you take care? So this is where we see the capital you want to invest, or whatever you have to invest, to be 100%. They want to know what percentage went here, what percentage went here, what percentage went there. Okay, so if I have like asset A, if I have asset A, then maybe the investment there is assets where I invested 50% in asset A, then I invested was it 30% in asset B, and invested 30% in asset C. What is happening now is that 50% of my risk is the risk that I associated with what? Asset A. Okay. 30% of my risk is the risk that associated with asset B, and 20% of my risk is the risk associated with asset C. So that those come together to form my what? My risk. Okay. Now, in other words, it means that you should invest less in the what? A more riskier what? Investment. Okay. And investment less riskier one. Investment. Okay. Now we also come to degree of diversification. Degree of diversification. Now we are saying that what is the correlation between the asset? You say you have diversified. All right. Now what's the correlation among the assets you have diversified? Okay. Imagine I have money and I said I want to diversify to minimize my risk. Then I go and invest in Zenith Bank. Go and invest in GC. Go and invest in what again? Car Bank. Now I want to know what's the correlation among these investments, right? All of them are in the financial sector. Now, what is happening here is that in case something happened in the financial sector, and when something happened in the financial sector, I said, oh, maybe the tendency that something in Zenith Bank coming down or going bankrupt, that if Zenith Bank is going bankrupt, there's high tendency that Car Bank will also be going what? bankrupt. GCB will also be going what? Bankrupt. You get me? Because of that, we advise that you, in diversifying, you diversify very well. And the correlation among the assets you invested in should be low, should be very what? Low, should be very low. So if I invest in the financial sector, the next one will be in the oil sector, the next one will be in the construction sector, the next one will be in agriculture. So the correlation among these are very what? Low, right? They are low. So meaning that if something is happening in the financial sector, it's not going to probably affect what? The oil sector. And I'll be safe there, right? I'll be better off diversifying with that degree of what? Diversification. Okay. This also throw light on internationalization and diversifying internationally. They also believe that if something is happening in Ghana, there's the tendency that will happen in US is low. So if probably my money is in US and something happened to Ghana right now, I can get the portion of that investment in what? US. Okay. Please, are we okay? Hello? Hello?
Hi, Doc.
Hello, Doc.
Are you
Well,
with me?
yeah, with you, Doc.
Okay. All right. Then we have hedging. Hedging. Hedging is you taking of certain position in order to what? Use your what? Your risk. Okay. So a typical example, I will use the exchange rate and what is happening that our Ghana cedi is depreciating, is devaluing, and the US dollars appreciating, right? And now it's like every money is appreciating against our currency. So let's say I want to do investment future. They are going to take a payment, the amount in dollars. Then I have to convert my Ghana cedi to dollars before what I'm able to execute that contract, right? And here is the case. There's a tendency that Ghana cedi, which is the currency I use or I spend in my country, Ghana, is going to depreciate against dollars. Meaning that if I don't do something now, by the time the future contract I'm supposed to execute, by the time it will get, I would have to take more money than what I would have used today to convert to what? Dollars to execute that what? Contract. Now, for me, please mute yourself. For me to prevent that or reduce that, right? I'll probably go into, I don't know whether these things happen in Ghana, right? We learned, I don't know whether it happens. So I'll probably visit my bank, probably Zenith Bank or GCB, and I'll go there and tell them, oh, I will buy this worth of dollars on this day, right? And I want to lock in, as I want to lock in the date, and see that on that day, that I would have to come and convert the money to dollars. I will buy it at this rate. Okay. So me doing that is minimizing my risk, right? Minimizing my risk that I'm going to buy the dollars at higher rates in future. So if I go into that agreement with them, then they agree that okay, so today I'm going to agreement. Now that is between 15 to 15 to this to 15 cedis to 16 cedis, right? To get $1. To get $100 and $100, $1, you need 15 cedis to 16 cedis to get $1. So I can go and lock in, go into agreement with Zenith Bank that on that day, maybe I'll pay 17 cedis. Right? I'll pay 17 cedis. Okay. Why I'm doing that is that on that day, it might be higher, it might be 20 cedis. It might be 25 cedis or 30 cedis. Okay. So I go into that agreement with them. Maybe let's say future contract. Okay. Then so that when the day comes, I will exchange it at what? 17. So it will be 17 cedi to what? $1 on that day. Okay. If they agree, then as it. So in other words, I've what? Like I've taken a step to minimize my what? My risk. Okay. Of me using more money than 17 cedis to buy what? $1 in future. Okay. So that is a practical example of what hedging. So hedging help to protect us against market volatility, unforeseen economic events, and potential loss. Okay. All right. Why do we hedge? First, to reduce risk exposure. To reduce risk exposure. So this practical example I gave, I've reduced my risk exposure. It enhances trading strategy. It enhances what? Trading strategy. Now, hedging is an enhanced strategy that is adopted when investment. And personally, I've learned it, but I've not seen it. And I've not witnessed it. Okay. Then it also encourage what? More diversification, right? More diversification. Now, when what we use, right, to hedge, they are called derivatives, right? And derivatives are examples of what? Financial instruments, of financial assets, okay? So in other words, you are buying another what? Financial asset, which is what? Encouraging what? Diversification, okay? So that is now this derivatives we use, example are what? Future contract, forward contract, contract for difference, options, and swap, okay? So we have, understand future contract and forward contract have the same meaning, that we are agreeing on a contract today and to be executed what? Future, okay? And it comes with what? We agree on it and execute in future. The only difference is futures is more organized, and it normally take place in an organized exchange market, okay? And it's less riskier because it's being monitored, it's being regulated. Forward is like a party. They set their terms and everything. And it's risky. If you come and meet me one-on-one and we are doing something, I don't do it. Okay. We have contract for different. We have option. Option is also like forward and future. Just that it's option. Option, you either exercise or not. Okay. And we have put option, we have call option, right? And we have swap. Swap is that one to agree to what? Exchange cash flow. Okay. So these are examples of the derivatives that is used for hedging. All right. We have the demerit of hedging, as in the disadvantage or risk associated with what hedging. Hedging cannot fully protect you, right? It protects you from what? Risks. It mitigates it. So we say it reduces your risk partially, right? It reduces your risk partially. Then sometimes there's what? Additional costs associated with what? Hedging. right? There's additional cost for you to protect yourself against this possible loss. You would have to incur what incur additional costs to do that. Then it's a complex strategy. It's a complex strategy. You need someone who has in-depth knowledge in the financial market, right? As I'm teaching it, I've not practically experienced how. And even though I'm teaching it and I understand it, I've been teaching financial markets. You being participating in financial market, the understanding you get is more enhanced than learning and coming to teach. Okay, so it's a complex strategy that needs someone who has in-depth knowledge to be able to do it. Okay, so that is the risk. That is some of the disadvantages with hedging. And we'll learn some terms that are under hedging, right? So we have cross hedging. And when we talk of cross hedging, it occurs when asset being hedged is different from the asset underlining what the futures or underlining the asset. Now, what is derivative? When we talk of derivatives, what is derivative? Derivative get their value from what? An underlining what? Asset. Okay. All right. So that is cross hedging. We have optimal hedge ratio. And this is you determine the amount of hedging instrument needed to create what? Effective hedge. So when we learn hedging into details, when you look at patients. I told you at this level, I'm not going to do any calculation. Just want to revise. Because I see that we are revising the concept in finance. Okay? All right. The market volatility, that is what? Degree of price fluctuation with a particular asset in what? In the financial market. Okay. So that is it. Now, when we have a long hedge or a long hedge, we normally use that when you place it an asset chart. Then we have short hedges when you sell an asset in the future. Okay. So that is hedging. Another strategy for reducing what? Risk. Now let's come to insurance. Is there anyone working in an insurance company? Is there anyone working in an insurance company?
No, Doc.
No. Okay.
Yes, please.
So when we talk of insurance, transferring your risk to another person, and mostly it's a company. But I think living here, I will not. It's very unlikely for allow someone to transfer some risk to. Okay. All right. So most is an company, right? So you transfer your risk to them, they get your premium for you. So, and the right time, in insurance firm will calculate your risk for you. Then you do the when if the risk occurs, then they will indemnify you, as in they will put you in your original position. Okay. Now there are some important terms in insurance. You need to know this thing. There's some important terms in insurance. We have the insurer. Insurer is the firm that is giving out the policy. That is selling policy to cover a loss, right? A possible loss. Then we have the insured. The insured is the person who take up the policy. The insured is the person who take up the policy. Okay. Then we have pooling of loss. Before I come to pooling of loss, let me talk about the law of large numbers. right? The law of large numbers. In insurance, we have the law of large numbers, right? So we are saying that a lot of people should come together, should be willing to protect themselves against a particular loss. So they'll be contributing into a pool, right? They'll be contributing into a pool, and in the few that will experience that loss will be indemnified from what? That pool. Okay, be indemnified for that pool. So this insurance will take. The insurance we take for our cars, which is legally required. I believe most of you wouldn't have insured your car. I'm one of them. But I don't trust the insurance company, so I wouldn't have insured my car if it was not a legal requirement, right? So that we are legally contributing towards. Only few of us will what? Have an accident that require them to go and take from the pool. Now, if you don't get large number, you will not be able to fulfill it because we are contributing something little, either monthly, annually, right? So if it's just one person or two who are interested in it, if the loss occurs, will you get enough money to take care of it? No. So you need large what number of people to bring their money to the pool. When there is loss, what? Base transfer is when you want to take insurance, you are transferring your risk to what? Another person, right? And you have indemnification. That is them putting you in the position you were before what? The loss occurred. Then we have premium. Premium is the regular amount you pay to the insurance company, right? So that was calculated by the underwriter. Okay. Now let's go. We want to know characteristic of insurable risk. Characteristic of insurable risk. We say that that risk should be accidental. If you don't intentionally cause something to the insurance company, if when they do their investigation and they realize that you did it intentionally, they will not indemnify you. No matter how long you've contributed, no matter how much you've contributed, they will not indemnify you. Okay? Then it should be economically feasible. Now, this insurance firm that they are taking up this responsibility or accepting the transfer of the cost, are they capable of indemnifying the person the risk occurs? If not, they don't have to take it up. They don't have to take it up. Then we have a large number of exposure units. Like I said, large number. To mean that a lot of people to be able to come together that they want to protect themselves against this risk. And when it occurs, they can take some out and what? To identify this. To be measurable and determinable. When you go that you want to know something, your child education, your whatever, your business, they should be able to measure and determine to be able to come out with what? The premium. Okay. So if it's not measurable, they can't come up with it. Okay. They can't determine the premium. So these are some of the characteristics of what insurable risk. So if for your risk to be insurable, these are some of the characteristics that should be what? These are some of the characteristics that should be what? I should tell it. Now we have reason for buying insurance, right? The first reason is to be compensated when a loss occurs. The first reason is to be what? Compensated when a loss occurs. And the second reason is what? Legal requirement. Like I said, some of us didn't register our car. It was not legally required, right? Then we have what? Requirement from lending. If you go and borrow money, like anytime who's working at the credit union. So if you go and borrow money and They will show you to insure the money against death or other things, so that in case you die, insurance company will what? Indemnify. Okay. The insurance company let them get. Okay. All right. Now I want us to revise the essential requirement of a valid. What makes a contract valid? The first one is there should be agreement, meaning someone should be able to offer something, and the other should what? Accept. Then there is what? Agreement. There should be what? Legal relation. Don't go and say you have offered that, oh, I'll bring you cocaine, 1 kilo of cocaine, and 1 kilo of cocaine. So there's agreement. No. If there's agreement, should be what? Legally bound. There should be what? Legal relationship. Whatever you are contracting in, satisfy the legal requirement of the land. Okay. Consideration. Meaning that the person should get some benefit from it. The person should get some benefit, some satisfaction from that contract. Okay. Then we have capacity. Capacity. When I talk of capacity, we are talking of your ability to enter into a contract. And in Ghana, if you are not 18 years, you can't enter into a contract. So that is capacity is you should be able to perform that contract. You should be able to perform whatever you're entering. So you don't take contract you cannot work or fail. Okay. Next one is we have minor, drunkard, mentally retarded. They are exempted from what? Entering into contract. If you are below 18, you can't enter into contract. If you presume that your mind is not working efficiently as it's supposed to, then you are not supposed to enter into contract with you. If I come and I give you, I talk to you whilst you are driving, I ask you to sign, or even I force you to sign, that contract is invalid because you were drunk. And mentally retired. Maybe someone is mentally retired and go into a contract with that person, not accept, right? Now, all these requirements is needed in insurance contract with additional distinguished features of what? Insurance contract. We say insurance should be arbitrary, meaning that it is terms. It is insurance is able to, okay, when there's affected our chance. Then we have adhesion. Adhesion. Talk of adhesion, it means that the contract was drafted by one. The other part in this is the sure as the towards the person to. That is why the insurance company always have their product, right? They have their product, so you either accept it or you don't like you reject it or you accept it. Okay, you can't go and tell them change this side, this side. No, it's not like two people they will read that you read, you like it, you take it, but you go. A personal contract means that the person who is entering into that contract should have interest in that whatever you want to insure. Okay. Then we have conditional contract. Conditional contract. It's a conditional contract. I don't know if you have gone to insurance company and you want to claim your money and they give it because you defaulted in some of the money. So this contract, you only be indemnified if you go by all their conditions. You pay all your you pay for about 5 years and you stop along the way. Then so there's something happened, you paid majority. They won't. And they have a legal backing. So it's only valid on the condition that you fulfill your part. Okay. Then you have unilateral contract. Okay? So an insurance company is normally sued. Let me use normally because I know an insurance company is normally sued by the insured. Meaning that the insurance company cannot take you to court. That the insurance company cannot take you to court that they have not been paying your premium. No, they can't. I went into agreement that I should be paying this amount of premium and you're not paying. No. But you can take them to court that they have not indemnified you and they've not been fair to you in something. You get me? So it's natural. Only one person can take legal action. The other party, the insured, can take legal action. I don't know how this entered into my channel. I think so. We want to understand some of the fundamental principles of insurance. Principle of ultimate good faith. This is what we learn in law of contracts. It's saying that you should disclose all relevant information, meaning you should be honest. That is in connection with what? The contract. Because we need that way to make decision whether I should enter or not. You don't come and give me partial information, the lucrative part of it, and I jump into it. Then later I'll know that all the lucrative united together. Merging all the lucratives in it, that disadvantage or that negative part related. Okay. All right. So we give you all the information. Misrepresentation. What is misrepresentation? Misrepresentation is fraudulently it's false statement, right? That induce a party to enter into a contract. And to be innocent is fraudulent, right? So misrepresentation. The material fact. It means that every information that is material means relevant. Every fact that is material, that is relevant, actually with whatever we are going into, should be disclosed, right? We have principle of indemnity, meaning that they will restore you in insurance. They restore you to your original position. They don't make you better off. So if you can insure your Corolla, I don't even know cars for my music. Then you go and insure your Corolla. That was 27. And there's problem with it, and they want to indemnify you. They're not going to give you 2020 model. No. They will restore it to your original position. They're not going to make you better off. No. Then we have the exemptions too. We have instances where you under-insure, over-insure, and for that to happen, there are exemptions. Then we have principle of insurable interest, meaning that for you to even say you want to insure, you have what? Interest in it. Mean if something happens to whatever you want to insure, there's loss, okay, it will affect you. It will affect you personally. Then that's what qualifies you to enter into insurance or to insure the loss. Then we have subrogation. Subrogation is stepping into the feet of another to enjoy its right or privilege. So in insurance, maybe your car hits someone on the road and the person goes to hospital, but the person has insured himself against, the person has insured herself or himself against accident. He's taken to the hospital and the insurance company comes in to provide the hospital bills and everything for him to get well. At the end of the day, you will not, the person who hit him, the person who hit him is supposed to take care of that expenses. Now, the money, you will not go and pay to the person that you hit anymore. Now, the insurance company is standing in place of that person to what? Collect that one debt. You get me? To collect that debt. I don't know if you get me. Okay. So, another thing, let me use, I think almost everyone has car here. So, if a car hits your car, cause damage, since you have insured your car, maybe comprehensive, you go to the company, the insurance company, they will what? indemnify you. After indemnifying you, right, the person who hit you was supposed to face it for you. You don't go and take that money to know. The insurance company will stand in your place to take what? That settlement, okay? Then we have contribution. Contribution is where all those who are liable to indemnifying you come together to raise money to what? To pull money together to what? Indemnify you. In insurance, they say they should put you into your original position, meaning you shouldn't make profit on it. Insurance is not a financial market that you want to, you go and invest in more than one. In insurance, we don't diversify. You don't go and diversify your loss. You want to diversify your insurance. No. If you insure the same thing with more than one company, now the idea is you don't want to go by the principle of indemnity, where you be put in the same position. You want to claim that amount for more than one company. That means you'll be better off. Hence, when they find out, if they don't find out, it's fine. But if they find out, and now we're in a digitalized world, so if they find out, they will come together and contribute to the money to get to what? They will contribute to put you in the position you were before you suffered the loss. Okay? So that is contribution. Are we okay? Are we okay?
Yeah, Doc, we're okay.
Let me see the
Insurance
time.
principles.
It's 4. Okay, I can teach this. Okay. Okay, so I want us to today the class has not been discussing enough because of this. I don't want us to spend we have spent meaning 5 days, we spent 2 hours.
Yes.
Wow. Well, then let me end this. Let me end this. I want to go. This one is not part of shouldn't be part of the letter because it's not a strategy for dating those. But I just wanted to add it to it to teach it since I'm going to teach. So then it's like my battery is going low. So we are going to start with the presentation, okay? So I'm going to end the recording and start again so that we have the one for the what. Yes. So I'm going to upload my first lecture on the YouTube platform. Oh, we discussed
We're not hearing you, Doc.
phase of what? Mitigating what? Risk. And we said, talk about what? So,
Doc, we're not hearing you.
we talk of hedging, gas, insurance. These are what?